Morning, everybody. The November 7, 2017 School Land Board meeting will now come to order. First item on the agenda is approval of the minutes from our last meeting on October 3rd, 2017. There being two board members present that were in attendance on that meeting, the two of us can move to confirm said minutes, assuming no questions, comments, or objections at this time.
I move to approve.
I'll second. Motion is made, seconded, and carried unanimously to approve the minutes. Next item on the agenda is approval of the consent agenda as posted. I've been informed that there have been no changes, no items pulled at this time. And after the board has had a chance to review and assuming no comments, questions, or concerns, we could approve the consent agenda as posted. We need to move to approve the consent agenda.
I move to approve the consent agenda.
I'll second. Motion is made, seconded, and carried unanimously to approve the consent agenda as posted. Items number 3 and 4 will be held in executive session. We'll enter and will do so pursuant to Chapter 551, Subchapter D, Section 551, Tech 071 of the Government Code for discussion consideration regarding pending or contemplated litigation or settlement offers, and to seek attorney or counsel advice related to items 3 and 4 on the docket, and subsection 551, Tech 072 for the discussion consideration concerning the purchase, sale, exchange, lease, or value of real property related to items 3 and 4 on the docket. Following this meeting, we will reconvene in open session to complete the docket. Open session of the November 7, 2017 School Land Board meeting will now resume with item number 3.
Good morning. Amber Long, Asset Management. Staff recommends approval of the disposition of excess land per the terms discussed in closed session. Any questions?
I have no questions, and I move to approve.
Motion is made, seconded, and carried unanimously to approve item number 3. Thank you, Amber.
Thank y'all.
Next item on the agenda is number 4.
Russell May with Asset Management. Staff is recommending the School Land Board approve the proposed development brokerage terms associated with Co-Investment 6 located in Fort Bend County, Texas, under the terms and conditions as presented to the board and being in the best interest of the state or PSF. May I answer any questions?
Any questions from the board at this time?
No questions. I move to approve.
I'll second. Motion is made, seconded, and carried unanimously to approve item number 4. Final item on the agenda is a non-voting item. Number 5 is stated.
Thank you, Mr. Chairman. Members, for the record, Rusty Martin, Chief Investment Officer. As you stated, Mr. Chairman, this is a non-voting item. I'm pleased to present you today with a quarterly investment report of the TexGlo Permanent School Fund Real Assets Investment Portfolio for the period April 1 through June 30th, 2017. The calculations and the statistical data that were presented in the quarterly investment report were prepared by State Street Bank and its Private Edge Group, which are the custodial accounting and performance measurement agents for the portfolio. I'll briefly give you a market summary of the period and then talk about the portfolio in particular. For the second quarter, U.S. GDP increased at an annual rate of 3.1% after increasing 1.2% in the first quarter of the year, and the unemployment rate ended the quarter at 4.4%. The Federal Open Markets Committee, or the Fed as we refer to it, once again slightly increased their Fed funds rate target range during the period by 25 basis points. The target range had been 0.75 to 1%, and they increased that to 1% to 1.25%. At the same time, they also decided to maintain their policy of reinvesting principal payments from its holdings in agency mortgage-backed securities and also rolling over maturing Treasury securities at auction. However, they did indicate that they expected to begin implementing a balance sheet normalization program later in the year, and that is going to gradually reduce their holdings by decreasing reinvestment of principal payments from those securities. They also expect that economic conditions will continue to evolve in a manner that's going to warrant only gradual increases in the Fed funds rate going forward. Thus, the Fed funds rate will probably remain below levels that are expected to prevail in the long run. As far as the assets that we invest in, as you know, real estate, energy, and infrastructure, the U.S. commercial real estate market is measured by NPI, returned 1.75% for the quarter. Its trailing one-year return was 6.98%. Industrial was by far the best performing sector at 3.07%. The other sectors were hotel, 1.76, retail, 1.52, apartment, 1.45, and office, 1.58. In the energy markets, WTI oil prices fluctuated in and around the $48 to $52 a barrel range for most of the period and ended the quarter at $46.02 a barrel. That was an 8.9% decrease from the first quarter ending price of $50.54 a barrel. Those prices were primarily influenced by an unwillingness of OPEC members to abide by their respective production quotas and the continued ramping up of U.S. production. The U.S. total oil rig count increased 14.2% during the second quarter, moving up from 662 to 756. However, many analysts are forecasting $60 a barrel oil pricing by the end of this year or early 2018 due to the stabilization of the U.S. rig count, normalized imports, mature field decline rates, growth in Asian demand, and an expectation that OPEC will deepen its production quotas after March of 2018. Natural gas prices averaged $3.08 per million BTU in the quarter, but ended at $2.98. That was a 3.5% increase from the first quarter ending price, which was at $2.88. The primary driver of those higher prices was warmer than normal weather in the U.S. Most analysts think that limited near-term production growth and growing export demand will probably lead to increased prices as the year progresses, and most also continue to expect that rising industrial demand, LNG exports, increased exports to Mexico, and continued coal-to-gas switching will create a tightening of the U.S. gas market in 2017. Turning to the report itself, if you look at page 2, the Performance tab, we'll go through some of these numbers and give you an idea of how the portfolio performed for the period. The total net asset value at the end of the quarter was $6.229 billion. Breaking that down, the external portfolio was roughly $2.91 billion, or 47%. The internal portfolio was $290 million, about 5%, and there was about $3 billion in cash equivalent investments awaiting capital calls. That also represented about 47% of the portfolio. As far as the external portfolio's performance is concerned, if you'll look at the first part of that chart at the top, you'll see for the current quarter, the return was 1.17%. That was slightly below our benchmark of 1.44%, 27 basis points below that. The real estate sector of the portfolio was up 3.01% for the quarter, and infrastructure was up 2.33%. But the energy sector was down, mostly on decreased commodity prices. It was down by 1.35%, and that dragged the overall return down for the quarter. On longer-term basis, though, if you'll look at the 1-year, 3-year, and 5-year returns, you'll see 1-year return was 17.68% versus a 5.96 on the benchmark, so outperformance by almost 1,200 basis points there. 3-year was 13.1% versus 7.69 on the benchmark, outperformed by 541 basis points. 5-year was 14.35 versus 8.79 on the benchmark, outperformance by 556 basis points. At the end of the period, about 36%, which is around $2 billion of our existing capital commitments, remained unfunded. 25% of real estate was unfunded, 42% of infrastructure, and 41% of energy. So that gives you a picture of where we expect the activity is going to happen over the next couple of years. If you'll turn to page 7 of the report.
Rusty, the last numbers that you quoted on unfunded, are they in here, or did you
No, they're not in here.
Okay.
If you'll turn to page 7 of the report, this is a new page we've added to the report, and it shows the external portfolio allocations by asset type on a net asset value basis. And so if you're looking at that page, you can see on a purely invested basis, the external portfolio was still slightly over-allocated to real estate. At the end of the period, it was at 35% versus a target of 33%. Infrastructure was at 25% versus a target of 32%, and energy was at 39% versus a target of 35%. However, I'll point out that all of this will continue to change over time and become more aligned with our policy allocation targets as more of the unfunded capital commitments to infrastructure and energy become funded. For example, the real estate allocation on an invested plus unfunded commitments basis at the end of the period for real estate was 29%, infrastructure was 32%, and energy was 39%. So again, those allocations shift actually on a daily basis as the capital is called. Also, if you'll turn to page 12 of the report, we have another new chart in here that was added, and this is added after some discussions with the third-party audit team that's been in here looking at our program for a few months now. So this is sort of a snapshot of our investment manager exposure. The chart's pretty busy. There is a chart on the next page. It's a little easier if you want to just look at the numbers. But what the chart basically is saying is on a purely invested basis, and again, this is net asset value based, the external portfolio is well diversified across 29 different investment managers. The investment policy statement limits the exposure to any one manager to no more than 20% of the total portfolio. The top 5 highest exposures at the end of the period were USAA Real Estate, that was roughly at 11%. It's followed by InCap Energy at roughly 8%, InCap Flat Rock Midstream at around 5%, and Morgan Stanley Real Estate 5%, and Lime Rock Resources just under 5%. We also grouped all of the co-investment vehicles, all the individual co-investment vehicles, grouped them by manager and presented them separately. And of those co-investment vehicles, First Reserve is the highest at 11.26%. That's followed by Intervest at 5.76%. As far as geographic diversification, the combined portfolio is close to the targeted allocations for each geographic region. Currently, the allocation to the U.S., excluding Texas, is about 83% of the portfolio compared to a target of 75%. International allocation is around 8% compared to a target of 10%. And finally, the allocation to Texas is about 9% compared to a target of 15%. This is a non-voting item. I'm happy to answer any questions you may have.
Any questions from the board? Thank you for the rundown.
Absolutely.
Thank you for the report.
Thank you.
Thank you.
There being no further business before the board at this time, we can go ahead and adjourn. Thank you.